Thank you so much. My name is Edward Leman, and I'll be presenting to you on monetary policy shocks, agricultural growth, and food inflation in developing agrarian economies. And this is the paper that I'm developing together with John Magombo and Lucius Cassin. This is the outline of the presentation, and I'll go straight to the introduction. So in this paper, what we're trying to do is to analyze the implications of monetary policy shocks on the agriculture sector output, as well as on food prices. And we're doing this in the context of a developing economy and an economy that depends much on the agriculture sector. The question that we are asking is, can a central bank that is operating in this environment, can a central bank operating in a developing and agrarian economy be able to influence agricultural growth as well as food inflation? If yes, how can the central bank do this? If no, why? You see, the prevailing understanding is that the central banks in these economies cannot influence agricultural output and cannot influence food inflation. Most of the times, the authorities think the growth in the agriculture sector should be influenced much by the fiscal part of the economy. And most of the times, they also think it is difficult to influence food inflation because most of the times it is determined by supply factors. So we're asking, can the central bank in these economies be able to influence agricultural growth and food inflation? You see, agriculture is very important in the developing countries because when we're talking about economic growth, basically it is the agriculture sector that contributes much to the economic growth. And when we're talking about inflation in the developing countries, for example, Malawi, Zambia, Zimbabwe, you see that it is driven much by food inflation. So overall inflation is driven much by food inflation. You will notice at the center of the growth of the agriculture sector and food inflation is the central bank. The central bank uses monetary policy to fight inflation. But notice, when they adjust the policy rate, for example, they are also raising the cost of borrowing. It means investment will be affected, and the growth of the various sectors will also be affected. So we're trying to look at this nexus. In terms of the motivation, what we have seen is that there has been rising inflation, stagnating growth of the agriculture sector, but at the same time, in these developing economies, the central banks have been tightening the monetary policy. So three things are happening. We're having inflation going up, we're having the agriculture sector not doing good, and the central bank raising the policy rate to fight inflation. A typical example is Malawi. We have seen rising inflation, we have seen rising food inflation, as well as declining growth of the agriculture sector. The growth rate for the agriculture sector has been below the 6% target according to the CADIP framework. Now, when you read the papers, you see that this slow growth is partly attributed to lack of significant investments in the agriculture sector. So because we do not have significant investments in this sector, we're also seeing that it is not growing as desired. There have been some papers that looked at monetary policy, inflation, but these papers do not look at the explicit nexus between monetary policy, agricultural growth, as well as food inflation. Now, a preview of the findings. This paper has found that contractional monetary policy causes stagflation in developing and agrarian economies. Two things happen when the central bank raises the policy rate. Number one, agricultural output declines. Number two, we have food inflation rising. Now notice, overall inflation is being driven much by food inflation. In the end, we also have overall inflation going up. So by following this conventional monetary policy, whereby we fight inflation by raising the policy rate, we see that the central bank is causing more inflation. So can the central bank influence agricultural sector growth and food inflation? The answer is yes. And we think by using the unconventional approach, we can be able to do this. Now, when the central bank is raising the policy rate, what goes into their minds? You see, this depends on the various channels, including the interest channel. So the interest channel depends on the dynamic IS curve, as well as the New Keynesian Phillips curve. As you can see from equation 4.1, output is negatively related with the interest rates. That means when you raise the policy rate, interest rates go up, we expect output to go down. But at the same time, if you look at equation number 4.2, you see that output is positively related with inflation. So when output goes down, we should also see inflation going down. So that's the interest channel. Now, in terms of the policy context, you see that agriculture has been prioritized in these developing economies, for example, in Malawi. Currently, we're implementing the Malawi 2063 agenda, and the first pillar in that agenda is actually agricultural productivity and commercialization. And of course, there has also been a swing. There have been times where we prioritize commercial agriculture, and sometimes we prioritize subsistence agriculture. In terms of inflation, you will notice that up to the 1980s, there was direct control of prices. So we had various boards that were directly controlling the prices. But between 1980 and 1990, we saw the coming in of the structural adjustment programs. Now, the roles of these boards was redefined. These boards do no longer directly control the prices, but they do this indirectly. For example, if you have low supply on the market, boards like ADMAC will flood the market so that the prices can be controlled. And when you have high supply on the market, the prices are going down. These boards, for example, ADMAC, they go and buy from the farmers. And in the end, prices are controlled. We also see the coming in of the Reserve Bank of Malawi Act. And now the Reserve Bank or the central bank is mandated to control inflation. To date, control of inflation is the mandate of the central bank. But we have also seen that the roles of these various boards that are used to control the prices has gone down. We have also seen some policy initiatives to boost food security and also to control food prices, for example, the affordable input programs. So this is the policy context. Now, when you look at these trends, of course, the picture is not very clear, but you see that, especially from 2006 going forward, it appears that when we have declining growth in the agriculture sector, food inflation goes up. But once again, the picture is not very clear. But when you look at this, you see the correlation between food inflation and overall inflation. Whenever food inflation goes up, overall inflation also goes up. And we can also see that the central bank is using the policy rate or is using the contractional monetary policy to control inflation. In terms of the methodology, we're using data from 1986 to 2023. And this data, we got it from the Reserve Bank of Malawi, as well as from the World Bank. And we're estimating a Bayesian structural vector regressive model. And the endogenous series that we have include agricultural growth, food inflation, the policy rate, as well as central government domestic debt. And of course, ET is just a vector of exogenous variables. More specific, we are controlling for precipitation as well as population in the growth model, and we are controlling for exchange rate and GDP per capita in the inflation model. And NT, of course, is just a matrix of deterministic terms. In terms of the identification strategy, we used the standard Koreske decomposition. And in terms of the structural analysis, we're using the impulse response functions. And we also used the Stock and Watson Hodrick Prescott filter so that we can deal with the the seasonality in the data. So I'll jump the descriptives and go straight to the results. Like I said, we see that agriculture sector growth is responding negatively to contractional monetary policy. When the policy rate is raised, there is a decline in the agricultural output. And these results are not new. They are in line with other papers, for example, Wagan et al. 2018. Now, when you look at these results, do we confirm the interest rate channel? At first glance, we may say yes, we are confirming. But when we go to this, you will notice that yes, we expect declining growth rate in the agriculture sector, but we also expect food prices or inflation to go down. This is not what we see when we look at the inflation model. What we notice is that when you increase the policy rate, inflation also jumps up. Therefore, an increase in the policy rate is causing more inflation. And this is in both food and overall inflation. So this is the response of food inflation to contractional monetary policy. Now, we can see that the results are contradicting the theory. We expected inflation to go down, but inflation is going up. These results, they contradict findings by Sami and Makun 2024, who found that tight monetary policy actually reduces food inflation. But these results are not new. When you look at Bhattacharya and Jain 2020, as well as Idrus and Arigdede 2020, you see that they found similar results. Specifically, when you look at Idris and Algdede, they concluded that rising food prices can further be destabilized by tight monetary policy in South Africa. So these results are not new. Now, how do we explain these results? Why do we think this situation can prevail in developing agrarian economies? Using an example of Malawi, you see that the conventional monetary policy assumes that households are forward-looking. So it assumes that households do have access to the formal financial sector and also have the ability to save. But when you look at these developing economies, you see that very few people have access to the formal financial sector. Therefore, the implementation of a standard monetary policy becomes difficult. And this is why we think that maybe the impact of the monetary policy is not very big, if you remember the graphs that I showed you. So we think because many people are not financially included, they do not have access to the formal financial service, that's why maybe we are seeing that the impact of the monetary policy is not very big. But also notice, Malawians do not borrow to consume. Malawians borrow to invest. If you can see from here, you will notice that 56% of the people that borrowed used the money to start businesses. And almost 30% used the money to purchase agricultural inputs. This is very significant because it means if you are raising the policy rate, you are tightening the monetary policy. People that are affected are those that want to use the money to invest and to produce, not necessarily to consume. Therefore, if anything, the people that suffer are the suppliers as compared to those that consume. We think in these developing economies, monetary policy is more manifested in the supply side as compared to the demand side. You see, the effect of monetary policy is on a net basis. We know it will affect supply will go down, and we also expect it to affect demand. But notice, if people are borrowing to invest and to supply, on a net basis, there will be more manifestation in the supply side as compared to the demand side. Therefore, it's not an issue of more money chasing few goods, but declining output against any level of demand. Also notice, the inflation that we have is coming from food inflation. And we know food is inelastic. Whether you tighten the monetary policy, people will still demand food. Now you tighten the monetary policy, people are not producing the food. The food is not there, but people still demand the food. It means when you tighten the monetary policy, you affect supply, but people will still be demanding, and therefore inflation will still be going up. Therefore, we think that indeed the monetary policy that we use in these developing economies is affecting us by lowering output and also by fueling inflation. So we moved further to try the triangular decomposition, and we found consistent results. We also tried the sign restriction. We found consistent results. We tried the time varying Bayesian SVAR on the impact of the monetary policy shock on agricultural output. We found that the impact is consistent. And on inflation, we also found consistent results. Therefore, we trust that the results that we have here are true and accurate because we tried all these sensitivity analysis. Now, in conclusion, We think that just like many developing countries, Malawi depends on the agriculture sector to grow. And the central bank, through the implementation of contractionary monetary policy, it is hindering the growth of this sector. And because there is no growth, output is going down, we see food inflation. Rising food inflation fuels overinflation, because if you look at inflation in these developing economies, it is largely food inflation. By fighting inflation using the standard or the conventional monetary policy, we are affecting the economy two ways. Output goes down, inflation goes up. Therefore, we think the standard monetary policy is not doing good to these developing agrarian economies, as it is achieving the opposite results. Now, why do we think the central banks have been misled? Monetary policy implementation in these developing economies is based on the standard framework, whereby we are told to raise the policy rate when we have inflation. When you look at the monetary policy committee or committees in these developing economies, you see that they base their implementation on the standard or the conventional monetary policy framework. Even the advice that we get from the African Development Bank, the World Bank, the IMF, is to fight inflation by implementing contractionary monetary policy, which is the standard monetary policy. And we think this is, to an extent, misleading. Thank you so much.